The strategy that you use to take your nest egg and turn it into a steady stream of income in retirement is one of the most important decisions that you'll make in retirement. This is for two main reasons. One, it will dictate how much that you can take out of the portfolio or withdraw per month, and two, how long that will last. And so in this video, I'd like to discuss the most common retirement income sources. Now, this isn't an exhaustive list by any means. There are multiple more sources, but these are the most common ones that you'll find inside your retirement income plan. The first one that I'd like to discuss is dividend stocks. Now, this is where you are part owner of a company. Think about Pepsi for an example. Pepsi Company has been paying out a dividend, meaning a share of the profits, to their shareholders, which could be you, for the last 54 years consecutively. And so this is what we call a dividend aristocrat. Again, consistent payouts, which is important to you in retirement, and consistent increases, meaning every year Pepsi has been able to, through their business operations, continually increase the amount that they pay you as a retiree. The reason this is especially important and desirable for people in retirement is because you want consistent increases in your income to be able to keep pace with inflation, therefore keeping pace with the lifestyle that you're used to. The next retirement income source is real estate. In this specific case, it's real estate investment trust, or REITs. This is a pool of income-producing real estate. Some are publicly traded, meaning you can buy it like a stock on the public market. You have to be careful though. I want to warn you, this is typically taxed as ordinary income. Since these pay a higher than average, typically compared to other sources, higher than average rate of income, the government taxes it at a higher potential rate. So not that these are bad, but you want to be careful when you're working with your advisor, or if you do your own work, you own these, if you own them, in the proper accounts to minimize that potential tax burden. Another common source that we see is bonds. This is where, rather than owning a portion of a company, such as a stock, you become a creditor. You loan your money to a company. So now we're loaning our money to PepsiCo in this example, and Pepsi has agreed to pay us a fixed rate of income. This is why you'll typically hear bonds referred to as fixed income. So it doesn't go up, doesn't go down. The only way you wouldn't get your income is if the company fails, goes into bankruptcy. So the bond ladder strategy is where you purchase multiple bonds with different maturity dates. For example, 2030, 2033, 2035, and you collect interest from them over the course of the years. The reason why you want bonds with different maturity dates is because if all your bonds matured at once, meaning come due, you get your money back and you have to put it back to work in new bonds. If they come due, say in 2030, and if we're in a low interest rate environment, now you have this big pot of money, no bonds, and you have to put it all back to work at low interest rates. Therefore, if you ladder out the maturities, only one may become due when interest rates are low. And so this is what we call a bond ladder, very common strategy for consistent and stable retirement income. Another very common source is annuities. Now, I like to say annuities are like a Swiss Army knife. They have this feature and that feature, but if you're not careful, you can cut yourself. And what do I mean by that? Well, there's many different types of annuities. Some are great, some are not so great. Annuities are tax-advantaged insurance solutions, and some of them provide guarantees such as maybe principal protection or no market losses. You put $100,000 in the annuity, and it cannot go below that, even though the market or stock market may be crashing. So some of them offer market protection. Some of them offer guaranteed growth, others offer income for life, or a mixture of these that we have here listed. Now, there's no free lunch. So of course, for some of these beautiful guarantees, you either have to pay a fee or you give up liquidity, meaning if you put $100,000 in, you can't just the very next day pull out $50,000. The next source that we're starting to see more and more as financial advisors is alternatives. Now, alternatives is a very broad term. Typically, it's anything that doesn't fall into the general stock market or some of the major publicly traded REITs or bonds. Alternatives are typically non-traded, meaning they're not on the open stock market, and they're investments directly into private companies. As the years have gone on, there's been a lot more private companies staying private for longer rather than going public on the open market. And so there's more and more opportunities in the alternative space, but I have to warn you, usually they're illiquid, so similar to annuities in the sense of you can't just get all your money out whenever you want it. because you're investing in a private company that may still be growing quite a bit rather than something established like PepsiCo. Typically, the reason why people are drawn to alternatives is some of them, not all, but some of them are uncorrelated from the stock market, meaning when the stock market goes down, some of these alternatives historically have stayed flat in value or gone up. So again, they play on a different rhythm than the broad stock market. Pensions are another retirement income source, although unfortunately here in the US, they're getting less and less common. Typically, the only time we'll see a pension as financial advisors is when someone is retiring from the railroad, post office, or any government entities, and some older companies that still offer them to grandfathered employees that are still there. All a pension is the company has saved up a certain amount for you based on your time in service, and upon your retirement, they'll pay you a set amount for life. Typically, they give you a few different options if you want something to continue to your spouse upon your passing. The downsides to pensions are you have no investment control, and if the pension is mismanaged, you could lose your pension, which has happened. Sometimes pensions will offer a lump sum payout right at retirement. They'll say, Mr. Smith will pay you X amount per month for the rest of your life, or we'll give you this huge lump sum of money right now. So a lot of times when we're planning retirement income plans for our clients, we want to take a look at the pension if they have one and say, do they offer you a lump sum payout or the monthly payments or both? If they offer a lump sum, we'll calculate, can we in other ways guarantee you a higher rate of income than what the pension can? If so, we'll consider taking the lump sum. And finally, on this list today, we have Social Security. So here in the US, this is our social income program for retirees. And it's, of course, the government group plan. We don't have control how it's invested for the most part. And typically we'll get COLAs or cost of living adjustments. Of course, being something that we all pay into, this is something that we are entitled to upon retiring. I try to tell people to not really rely on this that much. Of course, we've all seen in the news, I think, continually over the decades that needs to be restructured. So first we want to take a look at these other avenues really before calculating in Social Security. However, it is important, and I'll probably have some dedicated videos to that. Now, if you're interested in how some of these sources may be right for you in your retirement, click the link in the video description below. It'll ask you a few questions. I'll take those questions and I'll record a 60-second complimentary video, private, sent to you that you can watch in the comfort of your own home on your own time, giving you my opinion on your retirement portfolio and some of the potential sources of income that you may want to consider. Thank you for watching, and we'll see you next time.